Wheeling and dealing. We've seen quite a lot of it already to start 2025, with most market watchers predicting that this year will be a good one for deals. So to help explain what that means for investors and to list stocks with some potentially pretty massive upside, if the M&A thesis proves to be correct, is Rob Hay from Collins Street Asset Management. Rob, it's a pleasure as always. Thanks for coming in. Okay, so when you think about company balance sheets, what are the attributes that you really value?
When we're looking at a company, Nadine, we like to see hard assets. We like to see no debt. Debt is the enemy of a good investment. And we also like to see assets that have a real strategic value for the company, that align with their purpose and their meaning, so that you can see that they just haven't collected an odd assortment of companies or projects or assets over time with little rhyme or reason to it.
Okay, so those are the fundamentals. I have to say though, some companies with those attributes, even with good management, their share prices have sort of been stagnating. So what does that tell us? Does the market not always value those fundamentals?
Absolutely. Now, Nadine, of course, water always finds its level though. And where you have companies with known assets and known cash flows and a good management team, at some point that value has to be realised. Now, that could be realised as part of the half-yearly reporting to the ASX, where earnings announcements come out, you get upgrades. And if the market actually has confidence in those, you might even see multiple expansion, which is where you can see some really exciting price movement. What you could also find though with those types of companies, particularly in the smaller end of the market, is that they can be overlooked for quite a while. They're too small to fall on the radar of some of the larger institutional fund managers. And for long-suffering shareholders in the retail space, there may be a very pronounced lack of enthusiasm for them moving forward. Now, we're not interested in what a company has done, but what it will do for us moving forward. And so where we see that deep disconnect between the share market valuation and the fundamentals we described before, we'll take an interest. And the catalyst could well be for a re-rating, some wheeling and dealing, as you say, some M&A activity, and M&A is truly a global game.
Yeah, okay. So yeah, I did sort of skip over that M&A piece. What, in your view, is making for fertile ground for some of these overlooked companies when it comes to M&A?
It's a perfect confluence of events that have occurred recently, Nadine. What we have seen is a higher US dollar, which makes cross-border M&A activity a lot more interesting, particularly in the resources sector, because you'll find gold companies, for example, that are listed in New York may have an interest in acquiring Australian assets to roll up regions into larger, more scalable projects. Although we've also seen it in financial services as well, with Insignia and Bain Capital as another good example of that. Alongside that, we've seen lower interest rates in the US, and who could tell what the RBA does here in Australia, but with recent inflation data showing a drop in the rate of inflation, that would certainly provide companies with a strong balance sheet, strong cash flow, the opportunity to put that to good work and buy out other companies. And alongside that, Nadine, we've got the most important ingredient of all, which is a cheap price. And if the large instos aren't buying up these companies, if the retail investors aren't going in there, it's quite fascinating to see how other investors might weave their way up the share registry, taking a strategic stake, a little bit like we've seen with Retail Food Group, for example. And they'll buy out competition, they'll buy out strategic partners, and they'll get it at a song. And granted, they'll pick it up cheap, but if there's some competitive tension that's going on, or if it is truly a strategic asset, you can see some healthy premiums being commanded for that takeover and M&A activity.
Okay, so that's a high conviction idea for 2025, but also capital management. So these companies themselves, do you reckon that we could see some big capital management initiatives coming from some of these companies?
Yeah, absolutely. And water always finds its level, and there are some companies who don't have a natural M&A profile to them, but have great cash flows and a great business model. And if we have a think about Seven West Media as being one of those, they have the opportunity to pay down debt and to aggressively expand their equity position across their portfolio of assets. They're a company trading on 3 times forward earnings, for the premier media company in Australia, which is just incredibly crazy. But another interesting way of looking at it, Nadine, is that M&A activity rarely takes a linear path. There can be lots of twists and turns and complications along the way, and it does require investors to be patient. But what we can see throughout that process is quite often companies saying, well, if an M&A event is not imminent necessarily, then perhaps we'll start buying back our own stock. And we saw today, for example, Carnarvon Energy announcing that they will, from the 14th of February, set up an opportunity where they can buy back their own stock on market where they see fit. In the past, we've seen companies like Boom Logistics, who've upgraded their NPAT figures several times over the last few reporting seasons, continue to buy back their shares as well. That's a possibility. And so water will find its level, and either the market will come to realise that with multiple expansion, or eventually earnings per share just has to increase ever higher as the number of shares dwindle back down.
Now, I can only imagine that you mentioned Boom Logistics, Retail Food Group and Carnarvon because they are portfolio holdings?
Yes, they're positions that we've had for some time and which we're very excited about coming into 2025. The same principle, though, that applies to those companies could apply more broadly across holdings in the market as well. So you think about those good quality businesses that have had depressed share prices for some period of time could become quite attractive in this environment where we've got lower interest rates and we've got higher US dollar relative to the Aussie dollar shining through.
But on those three companies that you mentioned previously, do you reckon they could be M&A targets? Do you think that there's major upside?
There's a very real possibility for that. Carnarvon certainly have been having their Dorado project off the north coast of Western Australia for sale for some time. Now, more recently, we've seen some news flow where Santos, the major owner of the Dorado project, have put off the final investment decision for some time. And so that could be a complicating factor in that. Having said that, though, it could also be an opportunity for a suitor to come along and say, well, actually, now's going to be a great time for us to start making offers. So you never know on that front. Boom Logistics are a company with very little competition in the listed space, but Marmon Cranes, who are actually a Berkshire Hathaway company, being a private player, is certainly one that has expanded its presence in Australia and could be an opportunity there. Equally, you have a lot of mining services and equipment hire companies more broadly on the ASX that might have a commonality of customer base, they might service similar geographies, they may even be looking to consolidate things like warehouses and get some scale and efficiencies there. And so that's an opportunity for those sorts of companies.
Yeah. So when you talk about Boom Logistics in particular, does the nature of the business lend itself towards being a private company?
Quite likely. Certainly they've kicked some really big goals in terms of their fundamentals and their cash flows, and they're trading at about half of where their net tangible assets sit, which is quite incredible. The issue with a company like Boom Logistics, as fantastic as it is that the way in which they depreciate cranes will see a negative earnings per share or a reduced earnings per share figure, even though their cash flows are quite strong. And so for those who perhaps have a quantitative filter to begin with and they're screening out all of those companies with negative EPS or declining EPS, companies like Boom can get passed over. You also find companies like Boom have a relatively stable share registry. A lot of people are there for the same thing. And as a result of that, there's less liquidity in the stock. And so where there's less liquidity, there can be potentially less efficient price discovery, and the price can stay at those persistently cheap levels, notwithstanding the fantastic fundamentals that they have.
So if you were talking, and we'll just use Boom Logistics as an example, I mean, if we had a private M&A offer come through, or perhaps even from a bigger publicly listed company, is there any idea of how much you could see that share price lift by?
Look, the sky's the limit, and certainly we'd be delighted to see those sorts of things occur. If we have a think about some historical offers that have been made for Boom, and granted they were done in a different time and place and a long time ago, you can see these companies receiving offers sort of between 1 to 1.5 times, maybe even more, their net tangible assets. So if you're trading at half your net tangible assets at the moment, certainly no promises, no guarantees, but there is precedent for that type of upside to occur, which can be quite explosive and very event-driven, as you'd imagine, whereas companies like Seven West Media as a capital management type play are very much earnings based, steady as you go type businesses.
Retail Food Group. So this is a company that has been through a transformation, that has pretty strong management, that has also been acquisitive on its own, buying other brands to add to its stable. So what is the M&A case for Retail Food Group?
It's a very interesting company, and certainly as part of its transformation, it sought to shrink itself to greatness, which is an odd thing for a donut company to do. Nonetheless, that's how they started out, and they have been doing that. Certainly with Rack and Bones, where they've been using innovation and what have you within their pizza stores. They've got the pie business as well. What we have seen over the last 12 months or so is United Group in particular move its way up the registry to a fairly dominant position. And as a company, United have 500 odd service stations around Australia. They own the Pie Face brand, and you could see how there'd be a natural synergy between the two. And this is a good example of where those strategic assets, or where the asset being acquired means a lot more to the acquirer than perhaps what it might do to the market on its own, as a way of realising value. So who would know, who could tell? It's certainly an opportunity, and I suspect what you have to look at as part of all of this, Nadine, be it Retail Food Group or Boom Logistics or Carnarvon or any other company that's out there, is you have to also consider the experience of the board of directors and the strategy and mandate that they're operating to. Because companies may not always be looking to be taken over. They may be pursuing their own growth initiatives and seek to defend those takeovers in their own way as well. And that can make for some interesting back and forth between the suitor and the company, hopefully one which sees the share price go up over time, but which really does reflect how M&A is a patience game, and one where you have to do your research carefully in order to pick the winners.
Well, could you tell us whether or not Retail Foods Group's board is potentially inclined toward...
There have been media reports that they've actually sought to defend against takeover activity, and it will be a question of time as to how that plays out. What we do know, though, is that we have a company which is in pretty good shape, trading on 6 times forward earnings, compared to peers like Collins Food Group, which is more in the mid to high teens times forward earnings, Domino's Pizza, which is high, and then Gooman and Gomez, which is higher again. And to have these businesses trading at persistently low multiples, water will find its level. And it may be that someone inside the industry is the right natural owner for some or all of those brands, or perhaps fundamentals have to shine through and investors have to have faith again.
Water will find its level. I'll take that and put it in my investor toolkit. Just generally, Rob, how is the portfolio position generally? We had a conversation about gold a little bit earlier on, and I understand you've got a pretty high weighting to gold.
Yes, we have a basket of gold stocks. It represents somewhere in the mid 20% range of our flagship Collins Street Value Fund, and we're really excited about the prospects for gold coming into 2025. Certainly lower interest rates reduces the opportunity cost of holding gold and makes it attractive on that front. But the deeper symmetry and the just incredible disconnect between the spot price of gold and where these companies are trading at is just a dream for value investors. We have companies like Westgold, Ramelius Resources, who are trading, or Westgold in particular is a good example, coming back to the M&A idea. Last year they took out a company, moved into the 400,000 ounce per annum club in terms of their production profile, which moves them into an entirely new league in terms of how the market views them and the multiples that they can attract. We've seen the likes of Black Cat Syndicate, a company which has really come into production in earnest in the first quarter of this year with its Paulson's project in the mid-region of Western Australia, pouring high-quality gold and seeing its share price reflect that. So there's some really good opportunity there. And even thinking on the M&A front, there are companies like Tesoro Gold, which is one I think we had a chat about at some stage last year, where you have Goldfields, the $11 billion South African behemoth, owning a fair slice of the registry there. Now, as the resource in the El Zorro project continues to build up and expand, one could connect a few dots and see how that might be quite exciting to Goldfields, given they've got infrastructure and projects in the very same region. So it would make sense for them to have access to that type of investment if the JORC resource can really be firmed up over the years ahead.
Well, I'm glad I asked, because it does dovetail with this theme. Rob, I just think for our audience, like, tell us a little bit about Collins Street Asset Management and really what your point of differentiation is.
Collins Street Asset Management are very much run by investors for investors. We don't seek to chase the institutional prerogative of being all things to all people, holding index relative positions. What we prefer to do is focus on a concentrated portfolio of our absolute best ideas and back them with conviction, regardless of where they may be found on the ASX. And having that ability to be unconstrained, benchmark unaware, and high conviction enables us to have our thesis really have an impact on returns over time as and when it materialises. And so that's something which is very different to being overweight BHP or underweight CBA, those types of things. We can pick the eyes out of the market, back it with conviction, and have the patience to see it through.
That's why I asked, because it dovetails really nicely with the theme of today, High Conviction 2025. Now, I haven't asked this of others, but just talk to us about fees. What's your fee structure like?
We believe that if you're going to talk the talk, that you've got to walk the walk. And within the Collins Street Value Fund, we have no fixed ongoing management fees. We don't get 1% per annum simply to turn up, which can incentivise falling in love with stocks. It can incentivise growing the amount of capital you hold simply for the sake of it. What we have is a success-based model, which requires our investors to make a profit before we become eligible for a success-based remuneration. And so we're thoroughly aligned. And the way that it works, Nadine, is we have a high watermark, which is the highest price our units have been valued at, accounting for distributions to be fair, which we have to surpass before that success-based model applies. So hypothetically, if we started out with $1 on day one and went to $1.10 at the end of the month, we would receive 2.5 cents notionally, and the units would be worth $1.07.5. If in month 2 it dropped back beneath that level, naturally we can't earn a fee for losing somebody money. And if we go back to that level that we were before, the $1.07.5, we still don't get a fee because we can't lose money and then charge someone a fee to make it back. The bar only can ever rise. And so we back ourselves, and we back ourselves with conviction and share success with our clients.
Okay, well, because I know you can handle it, we have had a viewer write in. This is Mark. Thanks, Mark. And he is just pointing out the share price performance of Retail Food Group over the past year. So you did outline the case for potential M&A. Mm-hmm. What if that M&A doesn't come to fruition? What else will drive the share price higher?
Retail Food Group have a great business model, and they've been able to be very strategic compared to, compared to some of their peers. So for example, if you look at their pizza business, the local Domino's or Pizza Hut or whatever else will have their cheap Tuesdays and other things like that in order to essentially drop price in order to increase volume and keep the business going. Retail Food Group have been quite innovative and said, okay, if there's a downtime for pizzas, for argument's sake, perhaps we could use those pizza ovens to produce a different product, which is where their rack and bones comes in. And so rather than lose money or lose margin on a particular item that they're selling, they're able to pivot that same infrastructure to sell a different product and maintain margin. So that's one thing that's kind of interesting. The other is the network effect within Retail Food Group as well. The number of their franchisees who own more than one store is increasing half on every half that we go through. And so what that means is there can be some really good synergies and some value add offers for them, because the ingredients that might go into one product could be relevant to another. Some of the products they have in one store could be implemented or used elsewhere as well. So you can get some good synergies there between their different brands, and the proof of the cooking, as they say, Nadine, is in the pudding, and the franchisees are really going hard with it.